As the portfolio manager of the Platinum Unhedged Fund, can you tell us a little bit about the history of Platinum, your background and the investment team?
Platinum was started in 1994 by 4 individuals who had built up a great track record of managing money at Bankers Trust. In terms of my background, prior to joining Platinum, I worked as an accountant in audit. And today at Platinum, my role, so I have a few hats. One, I manage our financials and services team. In addition, I co-manage the European Fund and have managed the European Fund since 2009. And I also today manage our Platinum Unhedged Fund, which is a global fund.
Can you explain how you can manage a global equity portfolio from Sydney?
Really, we can draw on from a number of informational sources. So, one, we travel extensively to meet the companies we're investing in. Two, with the advances of video conference calls, they tend to bridge that distance gap quite well. And thirdly, we find there's actually an advantage of having the entire team based here in Sydney. It's just far easier to communicate ideas across the team and also far easier to hear about factors that may be affecting technology or mining and resources businesses that would also affect some of the stocks that we cover. So for example, the banks. So we need to know what's happening with banks that have portfolios exposed to oil and gas. So we find being in one place really improves the communication.
What is the Platinum Unhedged Fund and what are the investment objectives of the strategy?
The Platinum Unhedged Fund is a concentrated fund of our best ideas within the firm. And also it is a representation purely of our stock picking, so it has no currency or shorting overlay placed on it. And in terms of the investment objective, very simply, it's to make money for clients primarily through the capital appreciation of the stocks we own, and we do that by investing in underappreciated and undervalued securities globally.
Your strategy focuses on absolute returns. Is that because your focus is on stock selection rather than on a predetermined asset allocation?
We tend to focus on absolute returns because when constructing the portfolio, we pay zero heed to what's in the index or how the index is constructed. And because of that, the portfolio tends to look very, very different from the index. And a quick example is today, the index of the Unhedged Fund is the MSCI AC World. And the AC World has 53% of its assets in the US market. In contrast, the Unhedged Fund has 27% of its assets in the US market, so roughly half. And because of those vast differences, there will always be times when the returns of the fund looked very different from the index, both positive or negative.
Can you talk through the investment philosophy behind the strategy?
The investment philosophy is really that we try to seek neglect in markets. And another way to put that is when we're investing in a business, we should have a very, very clear idea of why other investors don't want to own it. So why does seeking out uncertainty actually work? And it really just plays on human emotions. So what we find in markets is when a company is doing well, we become confident that that success is going to continue in the future. And that gives me comfort in paying a high price for that business today. However, when there's a problem, when there's some uncertainty around a business, that all goes into reverse. Suddenly, we become very timid about predicting that business is going to get better in the future. We become very focused on the problem of today, and that leads investors to want to pay a far lower price for that business. And that's where the real opportunity is.
In terms of process, how do you select stocks for the portfolio?
So when you think about it, the majority of investment ideas are really thrown up by 2 factors. The first is that there's been a change in price. The price of a security has fallen for whatever reason it could be. And the second factor is that there's been a change in the underlying business which will affect the profitability of that business going forward. Maybe it will make that business more profitable in the future. And we can use a number of tools to discover these cases. So quant tools are one of those. So our quant tools can alert us to where there's been large price changes in securities. They can also alert us to where there's been a change in the sales growth of a business or a change into the underlying profitability of a business. In addition, we just have the knowledge that's within our global sector teams. So these teams will be looking at the speciality they have in their business coverage, and they'll be seeing trends that maybe say are happening in the US market that are applicable to similar businesses in Europe or Asia, but possibly investors in those markets haven't caught on yet. So through that process, we filter down to a specific list of prospective investment opportunities, and then the responsible analyst will be then charged to find out the information that we need to make an investment decision on those businesses. So it may be trying to understand why investors are uncertain, or trying to understand how important that fundamental change to the profitability really is. From that point, if we feel it's still a good idea, the idea will be then basically documented in a note, and we'll have a stock meeting where we pull all of the global portfolio managers together, and that idea will be debated. And the outcome of that meeting may be that, yes, we want to buy it today, or it may be today is not the right time, or it may be, no, we need further work to better understand some factors that we need to cover off on. But from that point onward, the decision to buy that stock rests between the individual portfolio manager and the analyst.
Being a global strategy, how do you determine the geographical disposition of the portfolio?
The geographic disposition of the portfolio will be completely driven by where the ideas are. So by way of an example, during the European sovereign crisis, when there was a considerable amount of uncertainty around the European markets, there were a lot of cheap stocks there. We were finding a lot of ideas, and therefore we had a higher weighting of Europe within the fund.
Your fund is unhedged to the Australian dollar. How do you manage currency, and why is an unhedged position part of the investment strategy?
So the currency position of the fund is simply where the stocks lie. So if I wish to own 3% in a German company, I by default will have 3% exposure to the euro. The reason why we have an unhedged currency strategy just goes back to the concept behind the fund. It's just an expression of our best ideas without any currency overlay or shorting.
What sort of investor does the strategy suit, and what's the recommended time frame?
Investors who wish to, one, have exposure to offshore assets, especially in a time when the Australian dollar is weakening. Secondly, investors who wish to get exposure to a far broader industry set than we have here in Australia will have interest in the fund. And finally, investors who value the differences. So our portfolio will typically look very different from other funds management products they may hold. And in terms of a recommended time frame, I would say 5 years minimum.